Okay. All right. Moving on. Moving on. So now we're going to talk about returns, and this is going to be, I think, a very interesting chart that we're going to talk about. And the reason we're going to touch on this particular chart is some of our dialogue is going to relate to valuations and where are stocks nowadays. And as we look at the stock market, we see this chart that shows a period from 2000 to 2009. So before we dive into this data, I'm gonna ask you a question, and the panel knows it, so I can't ask them that to jump in and give me an answer. But if we look at the last 30 years, so if we go back just before 2000, you look at the last 30 years of this U.S. stock market, and you say, which area of the U.S. stock market has performed the best? So you can choose from large company stocks, mid-sized company stocks, or small cap companies. And I think the most common answer for people would likely be large cap, which, believe it or not, was in last place of the three. It didn't do badly, performed at 10.1% average, but small cap and mid cap performed better. Mid cap was at the top, it averaged 11.2%. So, how does this happen? Well, when you look at a chart like this and you have a period of time from 2000 to 2009, large cap stocks, they can stumble. They've been fantastic in the last decade. Well, you had a decade during that 30 years in this particular time period from 2000 to 2009, and they really stumbled. They actually had negative performance during that 10 years. Mid cap stocks were up over 60%, small cap stocks were up 85%, and foreign, something we don't like to talk a lot about because foreign has really struggled in recent years. Foreign actually did much better than the S&P 500 as well. So when we look at this, were there any clues that the market was offering that could have tipped one off to see the coming weakness during this decade of those large company stocks underperforming? And I think the answer is yes, but it's not always as simple as that. So as we move to the next chart, we're going to start focusing and looking at valuations. So when we look at valuations, this chart shows how valuations have changed through time. When you're looking at the last 12 months, so that LTM in the chart, that's what that means. And we're going to look at the S&P 500, which is the large cap stocks. It's the navy line, and the S&P 400, which are U.S. mid cap stocks in light blue, and the S&P 600. So those are small cap stocks in the U.S., and that's the gray line. So if we go to the beginning of this time period, the year 2000, we see stark differences in PE ratios. So the PE is being the price of a stock divided by the earnings of a company, and a PE can help determine if a stock is overvalued, it's a higher number, versus undervalued or fair value, where you've got a lower number. And back in 2000, you can see here, large caps, they were almost double the PE of mid cap stocks, from almost just under 30 to close to 15 for mid caps. And we just viewed the chart before showing the significant outperformance of mid cap and small cap stocks versus large cap stocks during that period from 2000 to 2009. When you're looking at this chart, it appears that valuations, in fact, did provide a clue that large company stocks, maybe they were set to underperform. Is it as easy as this? Not necessarily, because what you don't see with this picture is if you went back a couple years earlier, from 95 to 2000, leading up to the beginning of this chart, large caps still were overvalued for quite some time, but yet they continue to outperform small and mid cap stocks during that time. So we fast forward to the last couple years. Small and mid cap now, they're undervalued, but they've been underperforming large cap stocks by a substantial margin, even though they are in fact undervalued today. So large caps, they've got a PE of almost 23, while small and mid companies, they're in the mid-teens. And as we look at this, we do in fact see that we think small and mid do provide an opportunity in the coming years to potentially outperform, but that trend just hasn't happened yet. We've seen some periods where small and mid have started to do a little bit better, only to give way to large company stocks. So we are waiting patiently for this opportunity. Let's move on though. So the S&P 500, and I'm going to talk a little bit again about PEs because I just talked about this, but PEs and the dynamic of PEs, they change over time. So you have to really take that into account, because If you're just looking strictly at PEs, you'd say stocks are pretty expensive now when we looked at that last chart. But the S&P 500, yes, even though it's statistically expensive since 1900, you have to question the validity of comparing today's S&P 500 valuation to history, given there's been many changes in the index's makeup over time, from asset light, healthier attributes of old company economic sectors to renewed focus on efficiency. Elevated valuations relative to long-term averages are one of the primary reasons that there are a lot of strategists out there on Wall Street still are conservative about how they think the near-term stock market potential, what's going to happen. But if we look at the S&P, and if we say the S&P 500 today is apples, you've got to look at the time periods in the past and say the 80s, 90s, and other periods are more like oranges, because there's a lot of factors. One is, if you look at leverage, the S&P 500 is about half as levered now. It's higher quality, and it has lower earnings volatility. And when you're looking at this particular chart, you can see that the S&P 500 index, it gradually shifted from 70% asset intensive manufacturing, financials, real estate companies. That's that yellow bar and teal bar in 1980, to now you go over to 2024, and you see now that 50% of the makeup is asset light tech and healthcare. That's that purple color tied to innovation here. So yeah, the companies in the S&P 500 today are just better by most measures. They operate with much more flexibility than companies in the past. You've got lower debt levels. The mix of the shift of the S&P now is shifted more toward nimble asset-light companies. And these companies are getting a whole lot more out of their workers, so much more operating efficiencies as well. And by the way, it's not just company fundamentals that have improved. You've got trading costs have come down substantially, which is another element that argues, for higher premiums in stocks also. So none of this suggests that PE ratios are worthless. However, you can't look at a single PE metric and say this is going to reveal everything you need to know whether or not it's a good time to buy or sell, especially in the short term. Valuations really don't tell you much about the next year. Certainly longer term, there's something we want to be clued in on, and we're keeping an eye on that. But small and mid, as we said, may provide an opportunity. So in thinking about those opportunities, this chart, I think, really starts to outline that lower interest rates that could really help improve small and mid-cap companies, as a significant amount of their debt is floating rate debt, meaning as interest rates have gone up, the interest rate borrowing, those dollars associated with corporate debt for small companies, has gone up on approximately about 50% of their debt. Large cap companies, and you can see the chart, they have fixed rate interest rates on more than 90% of their debt. That's like having a 3% mortgage rate in a 7% interest rate environment. That gives you a huge advantage. So if we see interest rates go down in time, small companies should see their earnings accelerate. And speaking of earnings, let's go to the next slide. So on the left side of this particular slide, we've got two charts here. Much of the focus in recent months has been on the Federal Reserve. But if you ask me what is the most important driver for stock prices in the long run, it's earnings. And as you can see on the chart on the left, stock prices and earnings have moved together. Over time, they just kind of intertwine and move, and they're very strongly correlated to together. On the right side, you're going to see the expectations for forward earnings. That's more of a recent snapshot, and expectations continue to march higher. Now, we might be in store for a pullback with stock prices soon. We don't know. And maybe analysts eventually find reasons to cut their outlook for earnings. But even if that happened, you look at these intermediate developments on monetary policy, interest rates, that may spark some type of gyration in stocks. But for now, the big story, though, is you look at this chart on the right, the outlook for earnings is extremely bullish. Earnings growth matters more to stock prices than the Fed policy does over the long term. And when you look at this particular chart, I think it's very indicative, hopefully, of a strong outlook for the rest of the year. But I'm going to hand that over now to Doug and Dan, and they can give you a better perspective from an economic and some other areas of the market.